you've been saving and saving that 20% or more down for your new home and think, I've been a great saver, I should be rewarded with a great rate. Well, not exactly. Today we're going to be talking about why a bigger down payment doesn't mean a better rate. First, let's cover the differences between an insured mortgage and an uninsured mortgage. An insured mortgage, or a high ratio mortgage, is when the borrower puts less than 20% down and is required to get mortgage insurance through one of the 3 mortgage insurers in Canada, which is CMHC, Sagan, and Canada Guarantee. This protects the bank in case the borrower defaults, as they're covered by this insurer. Currently in Canada, the max amortization period is 25 years and max purchase price is $1 million for insured mortgages. For first-time buyers, this is changing on December 15th to a 30-year amortization and $1.5 million purchase price. On the flip side, an uninsured mortgage or conventional mortgage is when the borrower puts 20% or more down. With a better equity position, there's no default insurance required. This can also be applicable to non-primary residences, such as rental properties or vacation homes, which do not permit insured mortgages. You may assume that larger down payment means lower rates, but that's not the case, and here's why. With an insured mortgage, the bank takes on less risk because that mortgage is backed by mortgage insurance. The borrower pays for this mortgage insurance, protecting the bank in case the borrower were to default. Essentially, the bank is bailed out by mortgage insurance if the borrower were to default. They're taking on less risk so they can offer a more competitive, lower rate. With an insured mortgage, the bank is on the hook if the borrower defaults. They have to keep more capital on reserve in case this default happens, making the loan more expensive to manage and making it more risky. In turn, the rate is slightly higher. So basically, if the borrower defaults on an uninsured mortgage, the bank is on the hook. If the borrower defaults on an insured mortgage, the mortgage insurer is on the hook. So what does this mean for you as a buyer? If you're taking an insured mortgage, you're going to be putting less than 20% down, you're going to be paying mortgage insurance and probably getting a better rate. If you're taking an uninsured mortgage, you're going to have to put a minimum of 20% down, and you're likely going to get a little bit higher rate than what the banks advertise as their posted rate, because that's normally an insured rate. You have to weigh the pros and cons of what's best for your situation when opting to take an insured or an uninsured mortgage. Although you have a lower rate with an uninsured mortgage, you'll usually end up paying more in the end after you calculate insurance premiums and paying off more interest than principal during the time. The flip side again, with an uninsured mortgage, you're going to have more equity tied up in your property, and in theory, you could be using that equity to invest somewhere else and likely make a higher return on that money. Obviously, both options are different, and you need to weigh either of these options and mortgage strategies for your personal financial situation. So that's a wrap. Quick breakdown for this week's video of insured versus uninsured mortgage. And although common logic may make you think that higher down payment means lower rate because lower risk for the bank, it's actually the opposite because of mortgage insurance. So thank you guys for watching, and see you next week for a new video.